Friends, for this video, I want you to go grab a notebook or a piece of paper or whatever, something to write with. Grab a drink, grab a snack. Um, I'm not saying I'm movie worthy, but what I am saying is that we're going to break down step by step, zero to hero, how you're going to get a home in 2022. Now, it's not going to be easy. It's going to take commitment. It's going to take sacrifice. And most importantly, it's going to take discipline. My name is Jorge de Jesus. For those of you who don't know, I am part of the Matt Freeman team in Katy, Texas. Katy's #1 real estate team. We're part of the Century 21 Western Realty. And in this video, I want to, however long it takes, I don't know how long I'm going to be here. I didn't plan times or anything. I just want to take you from zero to buying a home. Okay, so there's a few things that we need to clear up first. First of all, the screen needs to look better. So we're going to fix that. And we're going to start with your credit. What is credit? How is credit calculated? All that stuff we're going to get into in other videos. But as of right now, this is where you need to start. You need to find a way, whether free, like this website, or paid, way of finding out what your credit is. Now, I'm going to tell you right now, if it's under a 550, it's not impossible to get something done this year, but you need to do some soul searching and some digging to see exactly what's got it to that point. If it's 550 to 600, you're within shooting distance, okay? So you're going to find out what your scores are, and then you're also going to get reports on what's on that credit. Now, with every single step that we take here, there's going to be two ways of doing it. You can either hire someone to figure it out for you, or you can do it on your own. I'm always going to recommend that you figure it out with some sort of expert or somebody who is in this field, whether it be credit, loans, whatever it is, to trust them to guide you through the process. I understand there's plenty of people out there who are, let's be honest, scam artists, people who are not looking out for your best interests. So you have to do some digging. You have to do some researching to see who you should and should not work with. But there are credit repair experts out there, and if you reach out to me, I'll give you a list of mine that work in the Houston, Texas area that you can actually meet with them, actually get to know them, talk to past clients, that kind of stuff that I actually refer business to. Because it's tough. It's tough. I'm not going to take that away from you. It's tough to figure out who to trust and who not to. So you need to figure out where your scores are, and if it's on the lower end, you need to figure out what's in there. And you need to take care of those items however that expert tells you to do so. If you decide to do it on your own, I have no advice for you. You can go on YouTube and find different strategies and different letters that you can send and blah, blah, blah. But if you're anything like any of us, you're busy and you have other things to do. Whether you have a family or you don't, whether you have a job or you don't, you have other things that you want to focus on, right? So there's some things that you're just going to want to hire them out. So you're going to hire an expert to figure this out for you. They're going to tell you what is it that's holding your credit back. And then the shift is going to happen. The shift is this. They're going to tell you, or you're going to see if you're doing it on your own, that you've had a pattern of behavior that's led you to these scores. Okay? Now, of course, if I'm talking to you and you check your scores and they're over 620, 650, then pause the video, call your favorite realtor, and have them walk you through the next steps because you're ready. But if you're not, here's where we need to be. So you figure out that there's a pattern of behavior that's gotten you under 600 or under 620. There's some things that you did either when you were younger or you're currently doing or whatever it is. And look, I'm speaking from experience. I'm not better than anyone in any way, shape, or form. You know, I wish somebody had shown me this, and this is why I'm doing it. Um, you're going to figure out either you're using credit to pay for your lifestyle, or you have debts that you thought would just go away, or or you're living beyond your means, or there may be, just maybe, and this one does happen because it has happened to me. Somebody stole your identity. Whatever it is, figure it out. Okay, so you're gonna see what's on your report, and then you're gonna identify these patterns, and then you're gonna cut them off. You're gonna cut off these patterns 100%. Whatever the overspending, whatever it is, going out with whoever, it doesn't matter. I'm not here to parent you. I'm here to guide you to home ownership. It's up to you if you want to continue to listen to me. Then you're going to look at debt to income ratio. So basically, very quickly, I'm not going to get into super details. I just want you to hear the major steps, and I want you to kind of look over your life and say, well, this is where I'm at and this is where I'm not. Debt to income ratio, you're going to look at what your monthly expenses are. You want to focus on the ones that do require, that have some sort of part of it, like your car or a credit card or something like that, that does report to your credit. You have a child support payment, you stop making those, it starts affecting your credit negatively. So you want to make sure that you know which ones report and which ones don't, but just go ahead and throw all your monthly responsibilities in there, and then you're going to compare it to your income. Now, let's say, for a super simple example, this is probably not your example, but let's say that you bring home $2,000 a month, and your monthly obligations are about $1,500 every single month, which means that every month, excluding groceries and gas, you're bringing your 75% of what you make is going to bills. You never get to touch it. You never get to see it. It just goes to bills. And then that 500 is what you're surviving off of for gas and groceries. Okay? That 75% out of that 2,000, that 1,500, that's 75% is super high. What we will need to do is either increase your income, which, there's plenty of opportunities for everyone. I became a real estate agent. It took me a while, but I was in the service industry. I was a waiter, restaurant manager, all these things, and it wasn't right for me. I became a real estate agent to do better, right? I'm not saying everybody can do it, but I'm saying it's definitely worth taking a look at other opportunities. So either you increase your income, either by switching jobs, adding skills, whatever you prefer to do, or you lower your monthly expenses. That one's easier for most, okay? Or a combination of both. What we're trying to do, we're trying to target at most a 40% total. That's at most. We don't want it to go any more than that. So let's take a look at an example here. Whoops, I misspelled calculator. So, it's Pi Day. Awesome. Let's say you're bringing in $4,500 a month. Okay? Let's say that your monthly expenses are about 2,500. So you're about 55% debt to income ratio. That's super simple. Other things go into it. Before anybody does anything, this is a super simple example. Once you start working with professionals to guide you through this, you'll get the details. We want to be here or lower, no higher than this. Okay? So, why is it so important? I mean, you can just substitute my rent payment for my mortgage payment, and that debt to income ratio is going to be the same thing, right? No, it's not. Because it's not even about substituting these things. What I'm trying to show you is that earning a home, listen to this, not buying a home, earning a home for yourself is a matter of shifting attitudes, shifting behaviors, and shifting in mindset. Because what's preventing most of us from getting to that goal is a shift in mindset. Either you have a mindset of, well, somebody needs to give it to me, it's owed to me, or you have a mindset of, well, it's not for me, it's not in the car, so I'll just rent forever. Well, that's not something that uh, neither one of these mentalities are productive. Neither one of these mentalities are going to take you where you really want to be. And that should be the first step before doing any of this is, do you even really want to buy a home? You need to ask yourself that. You want to continue to rent? I'm not stopping you. I certainly am not stopping you. Take a look at this. To buy a $250,000 home, which in the Houston area, your average is actually more like 333. But let's say we find you something nicer, something that's ready to go, doesn't need a lot of repair, which we can do. This is your down payment at 3.5%, and then some closing costs. So it's more like total. You want to continue to rent? That's fine. The first 3 years, it's going to be about the same thing. But let's look what happens in year 8. You've paid $131,000 in buying something for yourself. Not all that money is going to be money that you can take out. A lot of it is in the interest rate. And I'll break that down in a second. But look how much in rent you're throwing away. None of that. You can't get any of that back. The best that you can do with that is use websites like, this is what I use for improving credit. Websites like Rental Karma, which what they're going to do is they're going to take your rent, and as long as it's in good standing and you haven't missed any payments or anything like that, then you'll be able to build credit that way. But look how much money you're throwing away. Let's say half of this, of the buy side, let's say only half of it, you actually get to keep, that you can get back if you were to sell. Let's say the other half is interest. How much of that rent do you think you can get back? So you need to fix your mindset towards ownership. You can do it. You need to get your credit report. You need to find out what's in it. You need to work on your debt to income ratio. And then I need you to put away at least $15,000. Now, I just showed you an example that says 20 and you should have 20. There's plenty of grants and programs, and I don't like talking too much about this because what I'm going to do is I'm going to have my lender in the next video talk to you more about this. But there's going to be grants and programs that are going to help you with some of these costs. But what I need you to do, and you're not even going to use, you're not going to use more than 5 or 7 or 8,000 of this $15,000. But I need you to have this money in the bank. Now, it's not all going to go to the down payment again, okay? Most of it is going to be, you're going to keep it tucked away because you might have repairs that come your way whenever you go to purchase. Maybe not right away, maybe over time. I want you to not touch that money. You might have repairs. You might want to do some improvements to the home. Let's say, for example, the home is in a certain area where the older homes are selling at $100,000, but if you fix up the kitchen and the living room, now it's worth $200,000, and all you put in was $20,000, right? Like things like that happen all the time. It's obviously never that simple, but I want you to have this money because you never know. Let's say you have an accident at work and you need to make these mortgage payments over time, and you need to have what if money. Again, it goes back to a shift in mindset. It cannot be stuck on that 75%, spending $1,500 out of $2,000 every single month. You cannot do it. You cannot own a home this way. You cannot survive this way, even if you are renting. Anyways, we'll move on. So in another video, I'm going to post some tips and tricks on how to save at least $20,000 because it's actually much simpler than it seems. It just might take you longer depending on your situation. Okay, so you've gotten your credit situation figured out. You figured out the DTI, the debt to income ratio. You're working your butt off to put this money away. And that's where I come in. I come in with a lender. That's where this is a team goes to work for you. Now, you're going to buy a home. Typically, in the state of Texas, the way that a real estate agent gets paid, and why am I telling you this? Because I want you to know that it's free for you, in a sense, okay? Typically, the way that a real estate agent gets paid is, let's say there's a seller. Let's say the seller wants to sell a home and it's going to be $200,000. Typically, not always, typically, that seller is, whenever the home sells, is going to give the agent that they're working with to sell the home 6%, let's say, on average. It's not always the case. 6% on average, okay? So out of that 6%, that agent is going to usually keep 3 as payment, as compensation for providing this service to the seller, okay? Now, why am I explaining that? What does that have to do with you buying a house? Who cares? Well, the way that an agent like myself that will work with you as a buyer, the other 3% that they're not putting in their pocket, that listing agent, that selling agent, is going to be offered to the agent who brings the buyer. And therefore, it gives incentives to agents like myself who can work with buyers. I work with sellers as well, but that work with buyers to bring buyers to these properties, show them the properties, and work. All parties work together to get it done. Okay. Now I pulled this up. Realtor versus real estate agent. I won't go into it too much, but let's touch on this. So let's say at the end of the day, this sold for $200,000. Let's say your real estate agent is going to make $6,000. Of that $6,000, take away fees for their brokerage, fees for their gas, their time, all these things that go into showing homes, working hard for you, da da da, all that stuff. Look, it's still a good living, but it's not always easy. So we make it easy because we're making it easy for you. So for somebody who works on commission only to make this transaction happen for you, let me back that up. Somebody who is not guaranteed income is telling you, we can make this happen. Let's make this happen. In my book, that's somebody that you can trust. Because if they were not 100% certain that there would be income at the end of the showings, the offers, the denial, the ups, the downs that they ride with you, then why would they even start the process in the first place? So a seasoned real estate agent, somebody who does work with buyers and does well working with buyers, like myself, will tell you right there from the beginning, along with a lender partner, look, we're ready to go. This is how much. This is the budget, da da da. Or we'll tell you, look, you should probably work on X and Y, and then let's revisit it in 3 months, 6 months, maybe give it some time. But let's say you've gotten your credit up to a 640, you have the 20,000 in your pocket, your debt to income ratio is down to about 43%, 40%, great job, bravo. What we're going to do is we're going to go talk to a lender. So you're going to be thrown a bunch of different jargon, a bunch of different scenarios, and a bunch of different vocabulary. This is where you rely heavily on a real estate agent to work with you. Now, before I dive into that, so a realtor is someone who is a real estate agent, but it's also part of the National Association of Realtors, which what that does, I'm a realtor. What that does is we have an extra layer of protection for our clients where if we do something wrong, if you're a regular real estate agent, yes, there's things that happen to us, but on the realtor level, it's even worse. So basically, I give myself an extra layer of accountability so that I do a good job for you. I'm also a Texas Association of Realtors member and a Houston Association of Realtors member. So it's another few layers of accountability and support for both myself and my clients. Okay, so now a real estate agent versus a realtor, it's up to you. I would suggest going with a realtor. Now a lender, you have a bank, you have a mortgage broker. What's the difference? What does it matter? I'm not going to break down the differences between all of them. Just know that banks offer certain products that have to do with lending you money to buy a home. But they also have checking accounts, savings accounts, investment accounts. They have 50, 60, 70 other products. When you have a lender or you have a mortgage broker, that person only does real estate related activities. They only help people buy homes or multifamily or whatever it is. They help people find fund these deals. That's all they do. They're not offering savings accounts and checking accounts. They're not offering toasters, and they're not offering anything else, just real estate. So in my mind, I hear that and I say, well, okay, let's work with a lender or mortgage broker. Who should I work with? Well, I'm not going to give you specifics. If you come to work with me, I'll give you my Rolodex. We can check who has the best, who offers the best terms. I'm not going to give you just one because it doesn't make sense to me. As much as I love these people, I want to earn your business and I want you to see that I'm 100% transparent. And every realtor should be the same way. So you're going to have some, most of these people, what they're going to do is they're going to take your financial information, and they have to. Okay. And here's one big objection that I get for a lot of first-time home buyers, from a lot of first-time home buyers, is that the belief is that I need to find a house, then go to a lender and say, hey, I want to buy this house. Lend me the money to buy this house. When the reality is, you go to a lender and you say, hey, how much house can I afford? How much of a budget would you give me to go buy a house based on my financials? Remember, you've worked on your credit, you worked on your DTI, you worked on your down payment, so you're almost there, right? Now we just need to find a house. But we need to make this stop with the lender for them to tell us, you and I, before we go shopping, what our budget is. It cannot be the other way around. Unless you have stellar, perfect credit, plenty of reserves, you don't really even need a loan. You just want to use a loan, and that's a whole class of buyer altogether. This is for someone who it's the first time, and we're still building credit. We're still building wealth. We're still building. So if you're in the still building rate, if you're still building, the lender has to be the first stop, and then the shopping happens. It can't be backwards. I would love to sit here and tell you about the 35, 36, 37 people that I've come across. Tell me, I want to buy a house. I found this house. Let's put an offer on it. Tell the lender this is how much I'm going to pay. Tell them to give me a pre-approval letter. And we'll get to that. Without ever visiting the lender prior to going shopping. Now, when I first started working with clients, I thought, okay, let's go. But now I know that think of your lender as a credit card in your back pocket, exactly like a credit card in your back pocket. If your limit is 300 and you go to Gucci and you want to buy out the store, you can't. So, lender first, shopping second. Okay? What the lender's going to do is they're going to do a pre-qualification where they look at your financials, they ask you a few questions, and then they give you an estimate of how, based on how much truth there is to what you're communicating. They'll give you an estimate of how much they're willing to lend. But when we get down to what's called a pre-approval, where they've actually run your credit, looked at your financials, gone a little deeper with documents, gone a little deeper with your history, that's a much stronger letter than just being pre-qualified. So what happens is, whenever we go, let's say we find our dream home, you say, hey, Jorge, I know the market's crazy. I'm pre-qualified for 250. Let's put in an offer at 235. I know the market's crazy. Let's go over asking price. I said, okay. I take a look at your letter and it says it's not a pre-approval. It's just a pre-qualification letter. Now, what's going to happen is when I send your offer, which is a piece of paper that says all the terms, and in a different video, we'll break down what an offer looks like. So it says all the terms, including price, closing date, and a bunch of other things. And if I send it with that letter, the seller's agent is going to tell me, well, I mean, Your lender's taking a wild guess on whether this person can be qualified enough to purchase the home or not, and I'm not going to put my seller through that. But if we go with a pre-approval letter, if we go with something a little stronger that's gone into further into underwriting than anything else, than this other letter, then it's a much stronger offer, and it gets you closer to buying a home. So you've gone to the lender, you've done all the right things, you've gotten your lender has taken a look at everything, and they're very confident on what they can lend you. Two things you need to do. Number one, keep that down payment money and extra money that I told you about earlier. Keep it in there. Don't touch it. Okay? Number two, don't go buy anything on credit. No large purchases are allowed until after you have closed on your home. Getting an offer accepted is not closing on your home, nor does it guarantee that the home will be yours. So you need to be certain that you know exactly what expenses you have coming up, and that, if something unexpected happens, okay, understandable. But if it can be avoided, don't go buy a car. Don't go anything that might affect your credit profile. You need to avoid it until after closing. Okay? So these are the steps that we've gone to. We've even shopped around. Okay, so what happens next? Let's say we had our offer approved. Congratulations. Now your lender's going to go into an underwriting process. The title company, which is a company that all they do is figure out exactly, making sure that everybody that is part of the transaction is supposed to be part of the transaction. Everybody that's supposed to, all the parties that are supposed to be involved, your homeowner's insurance company, your home warranty company if you have one, the seller's mortgage company if they have a mortgage that they need to pay off. They're going to make sure that all the money goes to the right places, and all the money goes to the right places on time. So you have your offer accepted. Title company says, let's get the process started. We tell the title company, let's get the process started. You go into what's called an option period. So an option period, typically we have a 5 to 7 to 10 day option period. Sometimes we don't have one, depending on what you want to do, but it's like a due diligence period. In this period, we're going to get the home inspector, we're going to get it checked out, we're going to make sure that it's in as good a shape as we thought, or if it's not, that period allows us to back out of the contract. Now, that period is not for free. So 2 payments happen right there and then as we're going to start the process within the first 3 days of our offer being accepted. The option fee, typically $100 to $500 to $1,000, depending on the price range of the home. You're going to pay that either directly to the seller or to the title company. I would recommend just giving it to the title company. If you decide to back out during the option period, that option fee goes directly to the seller. You don't get that money back. What you do get back is the second deposit that you're going to make. It's called an earnest money deposit, typically about 1% of the total purchase price. So if we're at $200,000, what's going to happen is, let me give you a real example. So this is a home that my seller just got under contract. Yay. So the buyer put in $2,300 in earnest money. What does that mean? So earnest money essentially is telling the title company, telling the state of Texas, and telling the seller that this buyer is serious about following through with this transaction. Okay? This is something that has to be given up front. This is not the down payment. This does not change down payments. Okay? Within the first 3 days, you're going to pay the option fee. You're going to pay the earnest money deposit to the title company. And then, after the option period, let's say you got an inspection report done, which usually run between $250 to $500, $600, $700, depending on the price point of the home, depending on how extensive the inspection is. Or if you have to do additional reports for different parts of the home, pools, environmental surveys, things of that nature. After that's done, let's say everything came out okay, no problem. What you're going to do is wait for instructions. And why is that so crucial? So typically, the transaction could be done within 2 to 3 weeks, okay? But there's two major things that need to happen for that to happen that quickly. Number one, you need to get in touch with your lender almost on a daily basis. Not on a daily basis, maybe once or twice a week. Make sure everything's on track. Make sure that you didn't miss an email. Make sure that you've submitted any and all paperwork that they've asked you to. As same thing goes for the title company. And number two, what's called an appraisal. And this is the part that people get tripped up on a little bit. So I'll try to explain as best I can. If you have any questions, comment below. I'll make a separate video just on appraisal only. Or you can call me and I'll break it down for you. Number's 832-588-0854. The lender is, let's say you use the bank. The bank is going to be the one that owns the house. I'm sorry. You owe money to that bank or lender, and until you pay all of that off, then you have the deed to the home, but you can't take off that obligation that you owe to the bank or the lender, which is called a lien. And if you don't pay them, then they own the home. So in reality, you never really own the home until you pay it off. You do on paper though. But that's after everything's closed. But before that, when we're still like within the first week, the lender or the banker is going to send what's called an appraiser. What this appraiser is a professional that they're going to look at the same data that I look at whenever we go to submit an offer. And they're going to say, this is my professional opinion of what the value of the home is. This is their professional opinion of what the value of the home is. Why is that important? Because the lender is making a financial investment in your purchase. And if that investment is not worth the offer price that you're putting on the contract, one of two things happen. They won't lend, and you'll say, okay, well, if you can't lend on that amount, then we're done. Or they'll only lend up until a certain amount, and then we can either renegotiate or you can make up the difference in cash. So let's say a real life example using this. So $239,000. Let's say that the appraiser came back and said, oh, well, it's actually worth $200,000. That's my opinion of value. And let's say that your purchase price, the price that we put on the offer that got accepted was $239,000. Well, two things happen. We terminate the contract. We're done. You get your earnest money back in most cases, and we can get into that. Or you say, I'll make up the difference in cash. Or you say, I'll make up the difference up until $215,000. Okay, so we'll change the purchase price to $215,000 if the seller agrees. Now, why is that crucial? Because once you have that appraisal done, and let's say you had to completely back out and you're done because you needed it to come in at the price that you needed it to come in at, the next person that goes up to bat to try to buy that home in the same process, in the same way, their appraisal is going to be about the same. So it's a strong tool for you to negotiate, and it's a strong tool for the lender to use because they need to make sure that their investment makes sense. Okay? Now, in the market that we're in at the time of this recording, you have a lot of people that are bringing a lot of cash into the transaction. So, let's say your offer didn't only had the 3.5%, 4%, 5%, 10% down payment, but it didn't appraise. You needed it to have that appraisal. You needed to have that value. You back out. The next person might be cash. The next person might be cash, which was actually what happened with this particular property. But so hopefully that makes sense. And then let's say you came in under contract at 235. The appraisal said, yeah, that's fine. You're going to put in 5%, 3.5%. We're going to lend you the difference. Okay, great. Perfect. The only thing standing in the way of closing completely is if your lender and or the title company need what's called a survey, which is a professional comes out and measures all the plot lines and make sure that your property is within your property. Maybe you find out that your fence is 2 feet inside of your neighbor's. Now, the sellers usually have this, so when they have this, it's not a big deal. Or if they don't have it because they've lost their documents or whatever, you need to get a new one. And that's another $400 or $500. Sometimes your lender will help you with that, sometimes not. So these are the kind of questions that you want to ask from the very beginning. There's a lot of other costs that go into lending as well and go into closing. We're not going to get into them. We're actually going to make videos specifically for those costs, so follow along. But this is just a general overview. So a few days, usually about a week, before it's time to close the deal, everything's done, the appraisal's done, survey came in, everything's good. Time for the down payment. The lender will coordinate with you on that. And time to go to closing, which is you and I sit down at a giant table at the title company. You sign some paperwork stating that you own this home and that you owe a debt to your lender or your bank or whoever. And you walk away happy with keys. And that's it. And you've come all this way and you finally have the keys. There's no but. You did it. And you're going to do it. And I believe that you're going to do it. But I want to make sure that you understand that it took taking a long, hard look at your finances. It took taking a long, hard look at your expenses. It took a long, hard look at your spending habits, credit habits, habits in general. Otherwise, it just doesn't get done. It's not a matter of being lucky. It's not a matter of finding the money. It's not a matter of it's a bad market. It's not a matter of any of these things. It's a matter of you putting your best foot forward, figuring it out, getting it done. There's a bunch of steps in between all of these things. This is just a really, really broad overview. I really don't want to get too... This would be a 3-hour video. And I don't watch 3-hour videos. I don't know that you do, but if you ever need help, have questions, I have my contact information on this channel. Reach out. Ask me anything. It doesn't matter. If you, for whatever reason, you don't want to work together, but you just want to ask questions, that's fine. That's perfectly fine. I prefer that you get the right information and not work with me than get the wrong information where you could have just gotten the answer. So we'll leave it at that. Just make sure that you're working on these things. Rewatch this thing or find a professional that will break it down for you. If this was too high level, I understand, but find a professional, find a real estate agent, find a realtor that'll break these things down for you. The right real estate agent will take the time to break it down for you, even if you're not ready now. Okay? Good luck, and thanks for watching.